Traders, good afternoon. Christian Farmers, Choppy Trade Group, and I'm going to do a quick video here. We have the Fed meeting at 2 o'clock today, and we have the press conference at 2:30, which usually lasts about 45 to about 50 minutes, depending on how long Powell wants to speak. So the most important thing will be that press conference, in my opinion, or maybe something comes out about the language at 2 o'clock, but usually it's the press conference that usually matters. You usually get an immediate reaction at 2 o'clock. And then sometimes the market doesn't end up going that way by the end of the day because something is said a little bit differently in that press conference. So just keep that in mind that, again, that press conference, which usually lasts about 45 to 50 minutes, is important. So I'm going to go through with the reason why I want to do this video is I've talked about this a few times about why the current Fed rate, which is at 4.5%, or that's their target rate, why that's very high, and sometimes why when folks talk about whether or not we need to raise or cut interest rates, why I think that the Fed needs to be cutting interest rates. So bear with me. With this analysis, and I understand that you may look at, oh, well, the market's not going down. The Fed doesn't need to cut interest rates, or the employment is not that bad. The Fed doesn't need to cut interest rates. So that is some arguments that we hear from time to time. So I'm going to go over why I have a different view on that. First of all, for this meeting that we're going to get in less than an hour from now, the chance of a rate cut is slim to none. It's 3%. This is what Fed Fund futures, by the way, are pricing in. So the Fed normally doesn't want to shock the market unless there's something really bad going on. Usually they kind of leak out what they're doing. So for this meeting that we're going to get, there's pretty much no chance that they're going to cut interest rates. September, which is the next, that's a month and a half from now, that's on the 17th, there's about a 57% chance that they're going to cut interest rates. Now that has dropped from yesterday. It was a 65% chance. So that's the way the market moves based on any type of language that we get. We heard Besant this morning talking about how they're not going to cut interest rates. So maybe that cut interest rates for today, but really I think it depends on September 17th. So let me go to now that we know what the market is implying, let's talk about why I think that they need to be cutting interest rates sooner than later. Again, it doesn't have to be today, but I think 2 cuts are necessary. So let's look at over time, and I think this will give you an idea of where I'm going with this. So if we go back to the last 30 years, right, here's what's been happening is that when you raise interest rates, right, you can't keep the rate that high for that long. So what do I mean by that? Or without it having an effect. Take, for example, right, they tightened interest rates going back to the year 2000. Why did they do that, or why did they need to do that? Well, speculation was running crazy back in 1999 and in 2000. So I get that they'd had to pump the brakes a little bit. But what transpired afterwards? They kept the rate high for too long. Why do I say that? Well, look at what happened to the market after that, right? They certainly tightened and tightened, and they left it there, and you had a pretty decent correction. And this is just a SPY chart going back 30 years or so, and look at what transpired. Right, for the next few years, the market. So it wasn't like that the market just took a breather from there, but that tightening, and I don't want to say that this is the only factor. There's many factors out there, but because they over tightened, the market corrected for a good couple of years. It wasn't till the beginning of 2003, 3 years, for the market to begin to go back up again. So that was a more extreme situation. They put those rates at 6.5%. Look at what they had to do thereafter. They had to yank down that rate very quickly. Right? Same thing happened. They tightened and tightened and tightened in 2005, and they left that rate high at 5.2%. Right? And they did that till 2007. Now, they did that because there was a lot of speculation, a lot of leverage in the system. So I agreed with them to having to raise interest rates in the first place. However, They kept it there too high. Look at what happened I know we all know what happened for the most part, or you should, in 2007 and 2008, but there was a major financial crisis then. Again, a lot of speculation in the housing market, but it didn't help that they kept interest rates there and then they had to yank them down. And whenever you do this, it takes a while whenever you cut or raise interest rates, it takes a while for this to trickle down into the economy. So they moved this from 5.2% all the way down to basically nothing in the matter, and they had to do that quickly because of how the economy was turning fast. So fast forward to where we are now. Right now, we were at 5.5%. Okay, they have lowered it to 4.5. This is still a high. You have to look at this overall rate and say this is tightening against the American people and the economy. And if you don't lower this rate soon, it's going to have a big effect, just like it has happened every other time in this market, right? Over the last 30 years, right? That when you over tighten and when you leave the short term rate there at 4.5% and keep it there, it's going to have an effect, right? Because it has an effect on the American people, right? Who are taking out loans and who are doing short-term borrowing. It's expensive. Now, it's very good if you're putting money in the money market, but that's not the overall economy. So the high net worth people are okay with this, and that's why there's trillions of dollars in the money markets right now, is because, hey, you could get 4.5%. That's much higher than what you could get from a few years ago. But for the overall person, for the regular person who's doing more borrowing than lending, right? It is hurting them, and it will hurt them over time. So it's not to say, so you have to be forward looking with this. And the longer that you keep rates high, eventually it's going to, in my opinion, it will cause damage to the economy. And again, look at it from the last couple years. One other thing that I'm going to mention to you is that please don't look at the TLT or the IEF, right? The Fed doesn't control the TLT, right, which is longer term rates. I know I'm using TLT as a benchmark for long term rates, but the Fed that moves as the 2-year, the 5-year, the 10-year, the 20-year, which is what the TLT models, moves on supply and demand, right? The Fed does not control that. The only thing that the Fed controls is the overnight rate. So let's look at what I want to look at what the 2-year rate is going to show you here. I might have to bring this up here this way. And this will give you a perspective of what's going on supply demand, right? So I'm going to bring in here, so US G, and I think I'll get it right here. And I want that. And let's see if that comes up. And I don't want this. So let's do this really quick. So the 2-year will tell us what's going on too. Notice that the last few times, as I mentioned back in 2000, right, the 2-year was up here and it started to dive before the Fed acted, right? So the Fed was late back here because the 2-year rate was already signaling that something was going on here. Again, the 2-year relies on supply and demand, right, where the Fed artificially holds the rate based on what they think. The 2-year, same thing. In 2005, the 2-year peaked in 2006, right, and then began to kind of move a little bit lower, 2007, and then really started to go lower a little bit before the Fed acted. Take a look at what's happening now here too. Do you see that this is starting to move the same way as it did in 2005 and 2007, right? If this gets further starts if the 2-year, and that's something to watch. If the 2-year starts to dive lower, you know that we're going to start to have most likely some economic issues, and the Fed should begin to lower that interest rate faster, based on what the 2-year is telling you. Again, that 2-year short-term rate moves on supply and demand rather than artificial holding of what the Fed is doing. All right, so that's my quick thoughts, and I hope that gives a little bit of knowledge into. It's not just the Fed, looking at what the market is doing now and the speculation. Right, there's forward-looking things here in play that'll give you a sense of whether or not on previous occasions when you put that rate up too high and you keep it there, it will usually, I don't, there's nothing 100%, but it will usually start to affect the economy, because this is at a rate of 4.5 or 5% is tightening. Right? It doesn't matter if they cut interest rates a year ago, right? That rate at 4.5% is still tightening against the American people. Leave it there, guys. That's just my 2 cents about the Fed. And even though they're most likely not going to move, what I would be looking for is whether they're going to signal that for September. Have a great